You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard. Welcome back to the Limitless Wealth Method podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. If you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life, one episode at a time. Let's get into it. Today, we're going to talk about the hidden tax nobody talks about: volatility. Now, most people think of taxes as something explicit. You can see them, you can calculate them, you even complain about them. Volatility doesn't work that way. Volatility is a tax you don't see, you don't itemize, and you don't fully understand until you've already paid it. And the worst part is, it doesn't just tax your portfolio. It taxes your behavior, your patience, your health, your decision-making. Today, I want to show you why volatility is one of the most expensive forces in building wealth, especially for high earners, and why most traditional advice understates the real cost. Because volatility isn't just discomfort, it's damage. Volatility hits different depending on how you make money. If you're an investor, it messes with your timeline. If you're a business owner, it shows up right when revenue gets squirrely. If you're an executive, it collides with concentrated stock, bonuses, and lifestyle creep. Same market, different pressure. Let's get clear on what volatility is and what it isn't. Volatility is not long-term risk. It's not an intelligence test, and it's not something that magically disappears if you stay invested. Volatility is the path your money takes over time, and the path matters. Two people can earn the same long-term average return and end up with very different outcomes, because the path forced different decisions along the way. No one lives an average experience. You live one sequence of returns, and volatility shapes that sequence. Most people hear the market averages 8 or 9% over the long run and assume that's what they'll experience. But no one actually earns an average. You experience returns in a sequence, one year after another, and that sequence matters. Volatility is what makes the sequence swing, and those swings quietly reduce what you actually end up with. Here's the simplest way to see it. When your portfolio goes down, the loss compounds against you faster than gains compound in your favor. For example, say you're down 20%. That means you need 25% to get back to even. Let's say you're down 30%. That means you need about 43% to get back to even. And let's say you're down 50%. That means you need 100% to get back to even. So even if two portfolios show the same long-term average return, the one with more volatility often finishes with less money. That's what I mean by usable return, not the return on a chart, the return you can actually keep compounding. And here's the part that people miss. Here's where the sequence matters. Imagine there are two investors, and over 10 years, they both end up with the same average return on paper. Investor A has a rough first couple of years. Then things stabilize and they grind higher. By the time they're making big life moves, the portfolio is healthy again. They can stay patient. Now, investor B, they have strong returns early. Everything feels great. And then late in the decade, right near the finish line, they take a major drawdown. Now, here's the difference. That drawdown doesn't show up in a vacuum. It shows up right when they're doing something real. Maybe they're selling a business, they're switching roles, they're buying a house, they're funding a buy-in, paying taxes, whatever. And because the portfolio is down right then, it changes the math of those decisions. They may have had to sell more than they planned. They may have to delay the move. They may have to take on debt they didn't want. Or they may have to lock in losses just to keep life moving. So they don't just experience a drop. They experience a forced decision. They're pulling money out when prices are down. They're locking in losses, and they're shrinking the base that's supposed to compound. Same average return, completely different ending wealth. Because one path let them stay invested, the other path forced action at the worst possible time. So volatility doesn't just create drawdowns, it creates lost time. And time is the one asset none of us can replace. We've seen this throughout history. Dot-com bust, when the NASDAQ fell more than 80%, and it took roughly 16 years to regain its 2000 peak. The global financial crisis, where the S&P 500 fell about 57% and took nearly 6 years to recover its 2007 high. Depending on whether you look at price only or total return, the timeline changes, but the point stays the same. Volatility can steal years. Those aren't just bad years, those are entire chapters of financial life. And you don't need an 80% decline for volatility to do real damage. Even smaller drawdowns, if they arrive at the wrong time, can permanently alter outcomes. Because the real cost of volatility isn't just the size of the drop, it's the time it steals. Volatility doesn't just move numbers, it moves people. And high earners aren't immune. In many cases, they're more exposed because the dollar amounts are bigger, the consequences feel heavier, and the lifestyle implications are real. Volatility creates pressure. It's pressure to sell, pressure to chase, pressure to do something. Most bad investment decisions aren't caused by ignorance. They're caused by stress. Volatility doesn't make people irrational. It reveals pressure points, which we talked about in the last episode. When volatility spikes, patience disappears, not because people are weak, but because something else in their life depends on stability. One more layer that matters today. The market is more automated than most people realize. Humans still decide what to buy. Algorithms decide how, when, and at what price trades actually happen, and they account for most of the volume. That doesn't mean markets are rigged. It means price can move faster than your nervous system can process. So if your plan requires perfect calm in the middle of a drawdown, it's not a plan. If you want to know whether volatility is a real risk for you, don't ask, how aggressive am I? Ask 3 questions. Number 1, what are my non-negotiable commitments for the next 12 to 24 months? Number 2, if my portfolio dropped 25 to 30% this quarter, what would I be forced to change? Number 3, what's the one decision I'm most likely to regret under stress? Selling, chasing, or freezing? If you can't answer those clearly, you don't have an investment problem, you have a structure problem. This is the tax no spreadsheet captures. Volatility doesn't stay in your portfolio. It bleeds into real life. Market drawdowns don't happen in isolation. They show up alongside career uncertainty, business cycles, health stress, and family obligations. When volatility hits a portfolio that supports fixed commitments, it doesn't feel like a number. It feels like pressure. Pressure reduces patience. Reduced patience degrades judgment. This is how volatility forces decisions outside the portfolio. You sell assets you didn't want to sell. You delay health priorities. Saying yes to work you should say no to. Freezing when opportunity actually appears. That's why volatility is destructive. Not because markets fluctuate, because timing gets taken away. And once timing is gone, control is gone. Most traditional advice treats volatility like a theory problem, right? Stay invested, diversify, don't react. That advice assumes stable income, emotional distance, and institutional time horizons. In other words, it assumes you're not human. It assumes you don't have a business to run, a family to support, a body that absorbs stress. Real people experience volatility layered on top of life. When advice ignores that reality, It fails exactly when it's needed most. Let me explain how I think about portfolio construction in plain English, because this matters more than most people realize. First, a hard truth. Static portfolios get people hurt. A lot of portfolios look diversified on paper. Stocks, bonds, maybe some alternatives. It all checks the boxes until the environment changes. And when it does, correlations don't behave the way the spreadsheet promised. We've seen this multiple times over the last decade. Periods where portfolios that were supposed to carry a certain level of risk suddenly carried a lot more, right when people could least afford it. So I don't build portfolios assuming the world will behave normally. I build them assuming conditions will change. That means I'm not trying to be right about the future. I'm trying to build a structure that can adapt when volatility shows up. Here's the simple idea behind my process. Before capital takes real risk, it has to pass through a few common sense checks. Think of them less like formulas and more like guardrails. First, what kind of environment are we actually in? Markets don't behave the same way in every environment. Sometimes growth is accelerating. Sometimes inflation is the problem. Sometimes both are slowing. Sometimes neither is working. These differences matter a lot. So before I worry about specific investments, I want to understand the backdrop, not headlines, not narratives, but the direction of the economy. That context helps avoid one of the most common mistakes investors make: betting aggressively in an environment that historically punishes that kind of risk. You don't need to predict the future. You just need to avoid fighting the current environment. Second, are my exposures aligned with that environment? Once I understand the backdrop, the next question is simple. Do the things I actually own make sense here? Every asset and strategy works for a reason. If you don't know why something is working, you won't know when it's about to stop. So I want exposure that has a clear logic, something I can explain without hand waving. That doesn't mean complexity. It means intentionality. The goal isn't to own everything. It's to own things that have historically performed well in this kind of environment. And third, is the market confirming the idea? Even a good idea can be a bad investment at the wrong time. This is where a lot of people get hurt. They fall in love with the thesis and ignore what the market is actually doing. So before increasing risk, I want confirmation. Is price behaving well? Is volatility stable or is it expanding? Is participation broad or narrow? If the market isn't cooperating, I don't force it, because forcing it is how volatility turns into a bad decision. Here's the key rule, and this is the part I care most about. I don't take meaningful risk unless the environment makes sense and the market confirms it. If those two things don't line up, I wait. Waiting isn't passive, it's strategic, because the fastest way to lose control is to press risk when conditions don't support it. You don't need my exact process, but you do need a portfolio that doesn't rely on perfect timing, doesn't assume markets will stay calm, and doesn't force decisions when volatility spikes. The goal isn't to squeeze every last dollar out of good times. The goal is to stay in control when conditions change, because volatility doesn't destroy wealth all at once. It destroys it by forcing action at the wrong time. And the right structure, not bravado, is what prevents that. Let me make this real for a second. Picture an executive who's doing everything right. High income, big bonus, a lot of net worth on paper, but most of it is concentrated. They have company stock, company options, and a portfolio built for growth. At the same time, life got expensive. He has a mortgage, he has kids, he has commitments. Then the market drops, and their company stock drops with it. Now the problem isn't the chart. The problem is timing. They don't get to wait for a recovery because their commitments don't wait. So they sell at the wrong time, not because they're emotional, because the portfolio wasn't built to support the life. That's the volatility tax. So I want to give you a few reframes worth sitting with. Volatility is not free. It has a cost. The best portfolio is the one you can hold under stress. Risk management isn't playing defense. It's how you stay in the game long enough to compound. And if you can't quantify it, you can't confidently size it. And a dynamic process beats a rigid model when the environment changes. If there's one thing to take from this episode, it's this. Volatility is not just discomfort. It's a tax on compounding, a tax on behavior, and a tax on decision-making. If volatility spiked tomorrow, ask yourself 2 questions. Number 1, what decision would it force me to make? And number 2, is my portfolio built to withstand volatility? If you don't like the answers, that's not fear, that's information. And the solution isn't to be tougher. The solution is to build a structure and a process that can adapt. Because the goal is not to be right. It isn't to be right. The goal is to generate returns and safeguard capital. And here's the part I want you to really internalize. Sooner or later, everybody meets the same moment, a drawdown big enough to test the plan. You need a structure where risk management is the highest priority. Because when the next crowded trade breaks, and yes, that unfortunately includes the AI trade, markets won't unwind politely. They'll reprice very fast. And if you're sitting in a static portfolio that was built for average conditions, that repricing doesn't just hurt your account value. It steals your compounding, it extends your recovery time, and it adds years to the plan. So don't build a portfolio that requires the world to stay calm. Build one that can survive when it doesn't. And here's the reality. The once-in-a-generation volatility shocks don't feel once in a generation anymore. They're showing up more often across more parts of the system. So assume the next volatility shock is coming and make sure you're built for it. If you got value from this, share it with someone who's doing well on paper, but they're one volatility spike away from a forced decision. And if you want more episodes like this, practical frameworks for money markets, leadership, AI, health, and building wealth with more clarity and less stress, make sure you're subscribed. And as we start the new year, here's the question I want you to sit with. Is your portfolio built to withstand volatility, or does it require the world to stay calm? I appreciate you listening, and I'll talk to you soon.